So after I see the messages sent by you on discussion forum. I have a feeling that most of you want to do the task individually. To me, it's perfectly okay. But one word of advice is that you must choose a company which has substantial amount of information. When I say information, it means the 3 statements should be well defined, well displayed. Okay, I would show you one template example today. When I say 3 statements, it should be the income statement of the company, number 1. Number 2 should be the balance sheet of the firm. And number 3 should be the cash flow statement. Don't you worry, I have mentioned everything in the, you don't need to write down. It's getting recorded, number 1. Number 2, they are mentioned in the slides. But the 3 statements should be, so in that case, if you pick up some small cap company, some small enterprise, then you are running a risk of not having enough amount of data. But if you pick up some well-established companies, like in Finland, if you ever get a chance, or I would take you through to Helsinki Stock Exchange, you will see that we have at least 25 to 30 very big companies in Finland, which are big in comparison to any other company in the world. But if you take some small company, because if you look at the listed companies in Finland, they are over 100. I think it's 103, if I'm to my last count. Not every company has adequate amount of data. So your first and the foremost condition criteria when you pick up a company should be that the company have enough adequate information. When I say information, it means 3 well-explained statements: the income statement, the balance sheet, and 3rd is the cash flow statement. Even though I can reveal a secret, most of the times, all the information that you need will come from income statement and balance sheet. Very rarely we would touch cash flow statement. You will know by yourself the reason as we progress. Okay, but do you have any questions or something? I just saw a couple of hands raised. Right, so these 3 things should be, but I'm happy if you want to do by yourself, why not? Okay, but one more suggestion. I think I said last time also that keep the same company for your second task as well, because then you are following the same company for a long time and you know more about something, you know, so you can really explore the phenomena. And again, I'm repeating that in this first task we shall detect or diagnose the riskiness of the company. Where is the risk? And in the second task, you will be doing the curing, you will be giving a treatment to the company that how this is the way they can do risk management. Okay, I'm sorry I don't have mic, so I can't speak very loud, so I can try to be as loud as possible. That's something, but do you have anything to ask before I start? If not, anytime you can stop me and don't let me carry on unchallenged. I want to explain that I think we had discussion about transaction last time. Transaction. The businesses are meant for transactions. The businesses are not that you leave the world, you renounce the world and go to Himalayas and take nirvana and do some moksha if you can achieve. No. A business entity, a company is a social phenomenon. Every company has social interactions. They have customers, they have employees, they have suppliers, they have the institutions which are as personal as people, like the government. They deal with the humans, they deal with the institutions. there is always some activity going on. When you buy something from Prisma, and let's say you buy some marker, there is an interaction. The interaction is that there is a cash outflow from your pocket. There is a cash inflow to Prisma. And then Prisma keeps its margin with itself, and rest of the money goes to the supplier who supply markers to the Prisma. And what you get a product. You get a product, you use it. For example, if the buyer is me, I come here and do some work on the board, and who's the beneficiary? Hopefully you, which itself is a social interaction. I mean, what could be better social interaction than the classroom? So a transaction is a economic transaction in the micro sense, but if I see in a more, if I see a big picture, a transaction is a social interaction phenomenon. We do interactions, we do transactions. I mean, you can call it an interaction when you meet people in the cafe or in the friends or in the class or in the uni. I can call it a transaction. So for me, that interaction is a synonym of transaction. The companies buy, companies sell, companies purchase, companies store, companies saves, company reinvest. These all are interactions. Okay, so remember, transaction is the first thing. When a company buys something, it gets something, it gives money, so there is a transaction, but you will know it slowly. Transactions are done with two mechanisms. The one is the cash transaction, and the second is the credit transaction. Cash, you pay. At the till point, you get a product or a service and come home. That's it. There's no time. It's like, what's the word in English called? Instantaneous. There is an element of instantaneity in the cash transaction, which means that you don't have to carry any baggage. You can carry a bag, but not a baggage. So there is nothing in the future to be settled. Things are settled then and there. In many cases, you can only have cash transaction. For instance, when you buy a grocery in the store, I don't think any company is letting you sort of credit transaction. Of course, you pay the credit card, but the company gets the money immediately. So basically, you swipe your card or you pay cash. It's a cash transaction. Nothing to be carried forward. But normally, I must say that when you have B2C transaction, number one, and number two, the volume and the value of transaction is low, then you often use cash transactions. Do you get my point? The transaction which are between businesses and customers, the end user customers. Number one. Number two, the value is small. It's not very high value product. You're not going to buy a private jet. You only need a shampoo. So you buying, first of all, the end user product and the value and the volume are comparatively low. In that case, we often use the cash transaction. Remember, cash doesn't mean currency always. Your debit and credit cards are cash. The card payment you do is a cash payment. Your net bank you use, if the payment is instant, there's hardly any delay. There could be minor, but that's not a big deal. But then comes the credit transactions. In the credit transactions, how can I write? Maybe this is better. I can't speak while sitting. So the second element of transaction is the credit transaction. Imagine the Finnair, the purchase manager goes to UAE and asks that I want to buy so many millions gallons of oil, okay, and will you supply it? They say, yes, of course, we will supply it to you. Why not? You're our customer, we will. And how much is the payment? And then they say so many hundreds of million euro. And then the purchase manager of Finnair asks his team, could you please bring the briefcases of money, suitcases? And then they're carrying suitcases on camels or whatever. And then they're giving it to them. Can you visualize it? You can visualize it? How does it look like? Wonderful. Very traditional. So imagine there's a till point and there is a cashier of some UAE oil company, and there is the purchase manager of Finnair, followed by some hundreds of camels loaded with the stacks of euros. No, that's not going to happen.
You're going to have an armed escort with those cameras.
Well, that's a different transaction. Yarko, that's a different transaction. Yeah. So, so that's why I said that it's all transactions. Now here what you do. You pay a card, or you don't even pay a card, you just sign the contract. That's it. And I know that for the oil companies, the lag between the delivery and the payment could be sometime 2 years, 3 years. Gap of payment, time lag. This time lag is signifying the credit payments. That this transaction is not a cash transaction, it's a credit transaction. Even as a customer, sometimes you buy very high value things and you don't make payment right there. Like look at the example of mortgage, the housing mortgage you buy a house, but do you make payment all the payment straight away? Unless you are very rich, you make the mortgage payments, isn't? That's a credit payment. Yeah, there you go. The second phrase, do you have any query about the cash or credit transactions? Are they fine? The next term, which I'm trying to introduce all these vocabulary to you so that you don't have any confusion in the future. The second thing we use in accounting and finance are goods and services. Goods are tangible. Remember in economics? Have you studied economics before? Have you? Really? I don't trust. Huh? Did you really study economics? Okay. Who was your teacher? Me? Not at all. Oh, you double check. We have goods and services. The goods are tangible. They are physical. You can see them. This is a good, by the way. Okay. You can see it. You know all the qualities. You buy goods, you sell goods. Do you? You buy goods, you sell goods. In accounting, we never use the word goods in the official records. We use the phrase purchase and sales. If goods come in, it's a purchase. Goods go out, it's a sales. So we avoid using, it will not be a crime against humanity if you use this phrase. For example, you can use the word purchase goods or sold goods. But if you only write the word goods, it doesn't say whether you bought or sold. Okay. Again, it's a matter of, it's not, there is no principle, but it's a matter of customs or traditions. We don't use the word buying. We say purchase, sales. Yeah. So purchase and sales. And services also, we buy and sell services. This we discussed last time. So this basically the goods and services are the same as we studied material and non-material goods. Okay, so there is no difference. Profit is the difference between the revenue and cost. The total revenue and the total cost is called profit. Remember, revenue is the amount of money or money's worth coming in the company because of your main business operations. That is called revenue. Did you get my point? You are a bank, you are providing banking services, okay? The money comes in, you sell some services, people pay you, it's a revenue. Okay, but if bank has an old furniture which is obsolete and they want to get rid of it, and they find that there is a salvage point, there's a junk point where they can sell this furniture in the second-hand market because they don't want to throw it away, it's still some utility, then this is not strictly revenue of the bank, because bank is not meant to buy and sell furniture. But for IKEA or for some other company which deal in furniture, this is the principal revenue item. Okay, so first of all, whichever company you pick up, you need to ask or check in the records what are the main principal goods what is the main business basically, what they sell primarily. Okay, so revenue is very, sometimes this can be very misplaced phrase. And the difference between the revenue the total revenue and total cost is equal to profit. If I can use the abbreviation PR and TC, I can say that if TR is more than TC, it's a profit, yeah? If total revenue is more than the total cost, it's a profit. But if total revenue is smaller than total cost, it's a loss. But there is a one catch here. The catch is that sometime when we say these words loosely defined or in the informal settings, we might end up say that gain, profit and gain, they're not same. Not even same but different. They are absolutely dissimilar. They're not same at all. Okay, the profit you get for your main business activities. You get my point? You sell furniture, you sell 5 chairs, you sell it for 400 euros. Your cost of producing these chairs is 300. This 100 difference is your profit. You sold chairs, you manufactured chairs, there is a cost of selling, then you get the revenue in, the difference is profit. Simple. What's the rocket science in it? But if you are, can I finish it first? But if, for example, you're having some bank deposit Of course, every company who sells furniture will be having a bank account. And you have a bank account where you have a deposit for, let's say, 100,000 euros are in the bank. And the bank is giving you 2% rate of interest. So it means that at the end of 1 year, 100,000 multiplied by 100, yeah, so maybe 2,000 euros are the interest you get. This interest is not your main profit. It's not part of your main profit. It's not part of your operating profit. But let's imagine you have some shares. You know, the companies buy and sell shares. The company bought a share for 10 euros and sell for 15 euros in the market. It's a gain. This is a gain. The gain is usually from the non-operating activities, and the gain is somewhat attributable to something which you have no control over. You have no control over. Can you control the stock market? No. You can make a good decision that, hey, buy cheaper and sell expensive. That's up to you. That's your wisdom. But can you really control the market? No. So basically, the profit is associated with your main operational activities, but the gain is associated with the non-operating activities. We do operating activities. We also do non-operating activities. Everybody does. Every company does. Okay. Loss is a loss. We use the phrase loss if it is because of the operating activities or non-operating activities. So regardless of operations or non-operations, regardless of main activities or secondary activities, loss is called a loss. Okay, you are producing chairs, which is your main business, for 400 euros, selling them for 300 euros. The market is down, you lose 100 euros. Okay, you are a furniture making company, but you also have a share. You bought the share for 10 euros and sell for 5 euros. It's a loss. So again, it's a loss. So the loss is something you need to understand, that regardless of main activities or peripheral activities or the secondary activities or not the main activities, basically, we use the word loss if you lose something. Yeah. And by the way, the profits and losses, we calculate them in our income statement, because they are, look, in income statement, everything comes which is recurring, which is continuous, which is regular. Can you see? The office, the building, the factory, your company is working 9 to 5. So those things which are happening frequently, what will happen frequently? Just try to visualize make some is coming, plastic coming, the electric equipment is coming, you process in your factory different departments, and then at the end you are assembling a product, selling it. There is a regularity element. So all the things which are happening continuously is called, will be recorded in the income statement. But those things which are not recurring, which are not continuous, that would be recorded in the balance sheet. For example, you never make $1 million worth investments every day, do you? You never buy machinery every day, do you? No. So then these things, because they are high value transactions, and they stay with the company for a long time. One more thing, one more difference. In the income statement, there is an element of continuity, but there's one more thing, that things come and go very fast. There is a that's what I mean by continuity. But in the balance sheet, you keep those things which, number one, are very expensive, And you don't do it every day. You don't buy and sell them every day because you are going to use them for many, many years. If I give you one example, let's move from factory to the kitchen, the home kitchen. You bought some home apparatus. Let's say you buy a refrigerator. Will you use and throw refrigerator the same day? It stays with you. I guess if all goes well, the average life of a refrigerator, a standard fridge, is 5 years minimum. So if you make your financial statements of your home, fridge would come in the balance sheet. Yeah? The vegetables, milk, all eatables, the toiletries, what happens? You use them quite regularly. They come and go. Yeah? I will never have a toothpaste which stays with me for 10 years. So what it means basically, it means that those items, those transactions, which are comparatively low value, continuous, they are coming in the income statement. And those items which are high value and you don't execute them on frequent basis, they would stay in your balance sheet. Okay? Sounds fine, but things will become clear when I show you the real thing. But let's wait for some more time. Yeah, actually I can show you right now. But where is that? Just a sec. Zoom, new share, screen here. Yes, I guess so. This is Finnair. We all know Finnair. The Finnair, and you know what? This would be the layout. Hopefully, this will be the layout, the design, the structure of any company you pick up. Okay, but remember, not all the companies have the same layout. So that's why I'm saying that, first of all, be familiar that your company has enough of information. And secondly, look, these accountants, you are 60, 70 people and you pick different companies. So there are 70, 80 companies altogether selected. The CFO of these companies don't know that you are studying accounting with SHAB. So they don't know the lecture slides which I have here. So it means that they might end up using the phrase which I have not discussed with you. I try my best that I should make you familiar with the different phraseology, and not only that, but also synonyms of those phrases. But sometimes, if you find some term which is not clear, always ask me or Seher in discussion forum or in person, always. You make sure that you know fully each and every item of your income statement, balance sheet, and the cash flow statement. I repeat, the cash flow statement is somewhat something which we shall keep a little bit at bay. But most often, we would be concerned with the income statement and the balance sheet. So make sure that every word, every phrase which you read, I mean, reading one income statement for the whole course, reading one balance sheet is not a big job, okay? And you will not have these contradictions now and then. Just one or two terms will bother you. Ask us before you make a mistake. Yes. Yes, Murray? Yeah. So you can check the auditor of the Finnair. You have to go a bit. Okay, let me show it to you. If I go a couple of pages behind, I want to see who is the auditor of Finnair. Okay.
It's a large company. Is a lawyer?
Yeah, we can check. I think it's a PwC, but we just check.
It's 87, right?
87? You said 87, yeah?
It is.
Okay, let's type in though. Why don't we just check?
Pricewaterhouse Group. It's 90, is this?
Auditor, yeah? Did you say 87? 90? Which page is this? A bit. This one?
No, it's 90.
90. Aha, okay. So this company's accounts are, sorry, this company's accounts are, you can see that there is some Mikko Nieminen, who is a public accountant. So he's a CPA or a CA. This person is actually the partner of PricewaterhouseCoopers in Finland, in Helsinki based company. So this company has authenticated that all the information which Finnair has disclosed, he would not say that is authentic or everything is good. He would say that, to the best of my knowledge, I could not find anything. It's wrong. See what? Look at the approach. If I say all you're doing is great, is good, and then I say all you're doing is not wrong, doesn't make a difference. So they will never say that you are following all the rules and regulations. They would say that we have not found any evidence that you're not following it. So they try to be very, very much diplomatic. Okay. So these accounts are basically well checked by some accountant. Can you name some other companies who are very big? We call them Big Four. Sorry? Valmith. No. I'm talking about the auditing companies. Those who audit, who are the, like look at the PricewaterhouseCoopers is a very reputed company. Is any other company you know? KPMG, E&Y, Ernst & Young. Yeah, and they have operations in Helsinki. Deloitte and Touche. Yeah. So we have 4. Yeah. There used to be 5 actually. Some, I think I told you, some 15, 16, 17 years ago, there used to be 5. And that company was called Arthur Andersen's. Arthur Andersen's. And you know what happened to that company? What?
Well, they went down with Enron.
Exactly. They were actually hand in glove with the company to manipulate data. Like a cop can be conspiring with a thief. We see in some Hollywood movies, then the cop, the good cop, bad cop. So there are some people who make some kind of, hey, whatever you do, I just look, okay, I look other side, you just do whatever. I haven't seen you. This kind of thing they did. And when this thing became obvious, so before the company got bankrupt, Enron, the Arthur Andersen got bankrupt. And if I'm not wrong, there were around 11,000 employees of this company, Arthur Andersen, who became unemployed for no fault of their, I hope so. So, yeah. So we have now big four companies. Of course, we have small companies in Finland as well. Not every company can approach these big firms, and it's not even required. If you are a Jyväskylä-based, some small company, private firm, you don't have to approach these companies. They're too expensive. We have some small firms, like we have one this, I have done some projects with them. My students work for them. Tieto-Akseli is not far away from here. So some of the firms are also there. So there are some small players as well, the big companies. All right, we go back now. We have to go, it's a long journey, yeah? I forgot to, oh yeah, there we go. The consolidated balance sheet. Income statement here. So you see here, should I? Yeah. So the company's revenue last year, 2000. Actually, you can even get 2018 report, but I somehow got this 70. But it doesn't matter. The revenue is this much. So these are in euro million. So I guess they got around 7 billion. Is it 2 or 7? 2. Yeah. So they got almost 2.5 billion revenue. And look at the word other operating income. These are operating income of Finnair, but it's not the main business. Maybe they are selling some technical expertise to an airline company in some small country. Or Finnair has an academy where they teach pilots and the crew members. Maybe some small country, developing country, doesn't have any training institute. And they say, Finnair, we pay you fee, can you train them? It's a Finnair's operation, by the way. But it's not a main operation. Yeah, can you see? We have to be a little bit discriminatory that these are the main jobs of Finnair. Or maybe this on-flight selling they do, maybe that is not the main business of Finnair, but it's a very small, something additional. But at the same time, it's not absolutely, it's at the same time, it's not completely alien business, okay? So we call them as some miscellaneous operating income. And then comes operating cost. So this thing and this thing, these two are added. But what do we minus? Okay, operating expenses. And what are the operations? Now, if you look at them, these all are the costs. Now, one thing you have to be very careful about it, that all these costs are regarding, these are the costs which Finnair spends while performing its operations. If Finnair is paying interest on bank loan, that's not an operational expense. Do you get my point? If Finnair is paying interest on bank loan, if Finnair is paying a tax, the direct tax, it's not a operating income, but all the expenses which Finnair would be incurring during the performance or executing of its core operations, that will be included in the operating cost. Be careful about it, okay? You can't just add any expense here. So for example, staff cost. Of course, you pay money to the staff. Unless you pay to the staff, how would you work? So all the pilots, technicians, air hostesses, stewards, engineers, the ground duty officers, all these people who look after the security check, who are employed by Finnair, unless they outsource to somebody else. But all these expenses which are directly spent by Finnair on its key operations is called staff cost. So this is the operating expense. And then comes the fuel cost. Can they run the flight carrier without filling in the fuel? You have to have, so that's the operation. Some rents, maybe they have taken some rental, some parts of, there's a new terminal which doesn't belong to Finnair, they pay rent for it. If they don't pay rent, they will not be allowed to park their aircrafts or to take passengers. They will not be able to operate. Hence, it's an operating expense. Simple logic. Aircraft, material, and overheads. If there's a problem, if there's some maintenance, you need to change the spare parts. It's an operational expense. Okay. Traffic charges, you pay traffic expenses to the airport authorities, of course. The ground handling and catering expenses, yes, you do this food stuff as well. Expenses for tour operations, you have some chartered flights to certain destinations in certain times, so those are special expenses. Sales and marketing expenses, you make your sales expenses, sales when you are delivering something, marketing to make it publicized. And if there is anything, multiple expenses, but they're very small in value, so you put together and call them as other expenses. But these are definitely related to the operations. So we call them miscellaneous or sundry or other expenses. And this way, what you get is the company's operating cost. And when you are subtracting all the operating cost from the, when you are subtracting all the operating cost from the total revenue, this plus this, yeah? So this plus this is total revenue, these two figures. And when you add all these figures, they put minus sign. I don't care about minus sign. Expense is a minus anyways, okay? So even though it's just in many of you, when you look at your income statements, they never write plus minus sign. So that doesn't mean that the revenue is expense or expense is revenue. So, okay, it's just a matter of convention. That's why I'm saying that be familiar with your data, with your company. And when you put all these minus expenses together, that becomes the total cost. And this is your what? 436.2. This is what? This is the, what profit is this? Huh? This is called your operating profit. This is called operating profit. This is called operating profit. Because this profit, I don't know what this R stands for. I will check. I'll check what this R stands for, but yeah. But this is, I'll come to it later on, but this is how your accounting statement would look like. So this is your profit. But this profit, I speak here. This profit is only, or I should say this way, this profit is arising out of the company's operations. Do you get my point? Look, I'm not subtracting the interest which Finnair pays. Of course, Finnair borrows, but the question is that borrowing is not the main operation of Finnair. That's why the interest is not an operating expense. you get my point? Borrowing is something, remember the first day we discussed the company financing? Borrowing is a form of financing. The interest you pay is a financing cost. It's not operating cost. Here, if you look at all these things from here to here, these are those costs which are straight away related to operations. If your bank loan is, if Finair's bank loan is delayed by a month or 2 months, their flights will not be grounded. They would still operate. But if they don't pay the tariff to the airport authority, they will not be allowed to take off their planes or even keep them in the, what is that word where they keep their, there's a phrase, what is that?
Hangar.
Hangar, yeah. The hangar where they keep the plane, the parking area, yeah. They will not be allowed to use the hangars off at the air, not the hangars, the jackets. Don't do that. Don't try with the airport, with the aircraft. Yeah.
How about toy aircraft?
Huh?
How about toy aircraft?
Well, you can play with that. Okay, so I try to remember, this is not the last time. This is not the last time I'm going to discuss these statements, but I just wanted to show it to you. So I'm not sure if you're taking it seriously or how seriously you take. I strongly recommend you that, first of all, take a company which has plenty of data. Big the company, more famous the company, more is the data. Number 2, make sure that you are familiar, or at least you have a very basic knowledge about every single word written in your statement, especially income statement and balance sheet. And if you're not sure, and I'm very sure that none of you will be sure with everything. So this element of unknown, not knowing it, or there's a lack of information, or they use different expression, you will all encounter this problem. And this is a good problem. It means that you are trying to increase your knowledge once you contact your teacher or teachers, which in this case is me and Seher. Okay. Yeah, these things you should be very careful about. A wrong choice of the company could be problematic, and if you start changing it afterwards, it will be too much of work, and it's not a very pleasant experience. Any questions so far? Okay, the next thing is the balance sheet. The balance sheet is very important. The balance sheet have 2 sides. We have the assets and we have the liabilities. Okay? Did I explain assets and balance sheet last week? Are you sure? Huh? Are you sure? Actually, I did. I did.
About assets.
Assets and liabilities as well.
No.
Did I explain 3 pillars of company?
Yes.
Okay, now listen. Again, if you don't remember, if you missed it out, don't worry. We can do it now. I think we discussed last time that there are 3 pillars of a company. Yeah, I hope you remember. But did I give this example by the way? 3 pillars of a firm. This is financing, yeah? And then these are investing. And then these are your operations. Look, one thing is very straightforward, very categorical. Everything which is about operations, this 9 to 5 stuff, or even 24/7, whatever, which is continuous, which is more regular, more frequent, is coming in your income statement. Will be dealt in the income statement. But then what is financing, by the way? Do you remember? Financing is the money comes from. Financing is where money comes from. If somebody asks you that what is the difference between finance and investment, because they are quite similar. No. They're different. Financing is money comes from. Investing is money goes to. Basically, the money comes from, remember the example, I split half of the class into equity holders and half of you were debt holders. This primarily come from the money financing, the money coming in, come from debt and equity. Debt and equity, yeah? Make sense? Financing. Financing is your liabilities. Can I say liability is what you owe to others? Remember the expression I use, I owe you. What you owe to others. If I'm a company, you are my shareholders, you are my debt holders, eventually I have to pay you. I owe you this money, don't I? In theory, I owe this money to you. And this is a main source of funding, financing. But what do I do with this money? I invest. Where? In the projects. I buy, if I'm Finnair, I'm buying aircrafts. I'm leasing in aircrafts. I might even make my own airstrips, or I can open up some training institute for pilots or whatever. So I invest. These are my projects. So when you sum up all the projects of a company, they become your assets. So that is where the money goes to. Okay. So investing is where you put your money in. You spend money on these things. IKEA borrows and have the shareholders with that money. IKEA, what will do? They will open their warehouse. They will buy the infrastructure. They will set up their store. And then they run the store efficiently. They operate the store efficiently so that what they get on the investment is more than what they pay to the investors. And only then you can be successful. If you start your startup company and your loan is sanctioned by the bank, and the bank says that use 100,000 euros for 10 years, but give me 3% rate of interest each year. That's your cost of financing. But if you invest all the 100,000 euros in the business, but your revenue is growing at 2%, not revenue, profit. Your return on investment is 2% each year. Can you survive? No. So it means that this 3% which you pay to your bank is a hurdle. You have to jump over it. You have to cross it. Okay? So that means that your revenue, your profit, your return on capital employed, return on investment should be more than 3%. And this is only possible. You can only jump over this hurdle if your operations are seamless, smooth, well taken care of, well planned. But if your operations are haphazard, very badly run, there's no control, there is no accountability, there's no efficiency parameters used, then definitely you can't cross over this thing. So what happens? Then you are wasting your assets at all. So what's the fun? Okay, so investing is where money goes to. So basically these are your, if these are your liabilities, then these will be your assets. If I use the word liability means I owe, then asset is what I own. So it means that assets is what the company own and liabilities are what the company owe. Just a matter of E and N, but that makes a big change. These are assets and liability. You make sure the big companies never keep all the money from its own pocket. It's not possible. You take public money in the form of debt, equity, combine it. That's your financing. Make investment in the projects. That's your assets. Okay. Now you have a liability and assets. You have you took a lot of money. You set up an airport. You have a fleet of planes. Now, what's the job to do now? Run those planes properly. Don't waste food in the air carrier. Make sure that there's not too much of staff in one plane and the second plane is empty and nobody's serving. The customers are angry. They never take your flight next time. One reason Finnair is so popular is because Finnair service for the long distance flights is remarkable. Whenever I go to India, I see many Indians. Of course, there'll be Indians in the plane to India, but they're not boarding basically from Helsinki. They're coming from Britain, Germany, Sweden, Norway, Netherlands, because they find that for the long distance flights, the Finnair service is remarkable. And how it's possible? So it means what? They are operating. This is a operational efficiency of Finnair. Does it make sense? So it means Finnair is operating so that it makes the most optimum use of its assets so that it generates more revenue so that even after paying the cost of financing, the firm is surviving, rather getting stronger day by day. So be careful, before I take your queries, I've seen some hands raised, but be careful that never forget this picture. Financing, money comes from. Investing, money goes to. Financing, you owe people liabilities. Assets, you own them. Okay? So these things are very careful. And here you pay, from here you get. What you get should be more than what you pay so that you are financially viable. But one thing, I would say that your assets are equal to or more than liabilities. It's very important that you people, first of all, please tell me, is it clear, this pillar thing, 3 pillars? One more thing, which you must be super careful. I think this is the best time to learn it. It's called, maybe I use a different pen. I don't want to remove it. What do we do with this? This is called, can you see it? Is it visible? Equation of balance sheet or balance sheet equation. assets are equal to liabilities plus capital. Let's call it equity. Equity capital. I have to be precise about it. Okay? Assets are equal to liabilities plus equity capital. Equity capital. Now, I want to give the same example. Let's keep it simple. Let's not go to Finnair and these Walmart, these companies yet. Let's keep it simple and short. Mari gave an example, or I try to bring Mari as a character in this example. She, last year, started a business as a startup company. She took 10,000 bank loan. Bank loan is a liability, yeah? Eventually she has to pay back. Did she invest any money from herself? I assume nothing. Nothing she invested from her own pocket. So I can put 0, yeah? Liabilities plus equity capital. And then with this money, what she does, let's say she invests in the business. Of course, she starts her operations. Is any ambiguity in this equation? Is any doubt you have now?
No.
This was last year. Then what Mari does, she works very hard, and because of her operational, look at my fingertip, financing, 10,000 bank loan, starting a business, investing, assets, 10,000. She is making the best use of her resources. It means she is making an optimum utilization of her assets. So her operations are great. And what happened that she earned 3,000 euros as a profit. And let's say what she does, she says that I don't need any money. I think I want to reinvest this money back to business. And what she does, her bank loan is still 10,000. She neither took new loan nor she repaid yet. But her profits, which comes here, 3,000 profits, they become assets. How? She is putting this money back in the business. Her loan liability is still 10,000. Now her equity is 3,000. But what would she have done with this extra 3,000? She might have bought some more furniture, new computers, some new investment, some kind of new investment. Some patents, some copyrights she bought. And what happened is that now her assets are 13,000. Does make sense? She earns a profit, reinvest. This reinvestment is her equity capital. She was a completely externally financed startup last year. This year, she has invested her own money from her own pocket, own investment. But when she invests, of course, she would do something with that money. So the assets will also jump to up. Yeah. So this equation, you never forget that assets are equal to liabilities. Liabilities are those which you owe to the outsiders. Equity is what you owe to yourself. It's very important. Therefore, I say that equity is your own money. You always feel more pressure to pay outsiders. If a company is going to be bankrupt, then first outsiders would be paid. Then if some money is left, you have a claim. So basically, liabilities are what you owe to the others, and capital is what you owe to yourself. One small point, and then I give you a break. It won't take more than 2 to 3 minutes. It's very important to tell you now. Now, please pay attention to this sentence because you might find a contradiction, what I say. Liabilities are what you owe to the others. And equity is what you owe to yourself. But then you can ask me, Shab, on last week, you gave us an example. And you split the whole class into 2 parts. Half of them were equity investors, and half of them were debt investors. It means that they're not me. You are outsiders for sure, because you're debt holders. But how about these people? Are they me? No. But once they become shareholders, they become part of the company. There's no difference between them and the company. So therefore, even though in persona, they are separate human beings, but they are not separate from the company because they chose to become the equity shareholders. So they are embraced by the company. But you people, you are investor, but you keep an arm's length from the company. So therefore, you are the external investors. They are the internal investors. Hence, their money is basically company's money. So therefore, if the company happens to be in a crisis, the company would first pay you people. And if something is left, they have a claim. But then, don't be sympathetic to them. They wanted to earn more profits. It's their risk. Okay? So it's very difficult. It's very important that you also understand the nature of people who are giving the finance, like investment. Okay? We take a break now. It's 2:45. We resume at 3:05. So about 20 minutes.